joins us now. Morning, Pramod. Good to have you on a day when the markets are green everywhere, all across the world. Well, first, interpret the European liquidity easing warning to us. How should investors approach and interpret this event?
I mean, look, in the short term, you've seen how markets across asset classes have reacted here. It's clearly another gush of liquidity and a promise to keep that gush of liquidity keep coming for some while to come, which means that the markets tend to react on a relief rally. But I would think it's time to step back and think about what this liquidity has done for the fundamentals of the global economy, be it in the developed markets or the emerging markets over the last 7 years since we've seen these sort of extraordinary monetary policy actions. On the ground, there is clearly a debate. America has clearly benefited somewhat, but not really, as you've seen with a little bit of jitter from emerging markets in China. The Fed also decided to push back the rate increase. So it is not exactly clear that further money printing or quantitative easing can actually make a difference to the demand-supply situation globally in terms of fundamental economics. So I'm not sure that the market will get swayed from a long-term perspective by this another gush of liquidity. I think the market may see through it this time around and continue to question whether this will actually have any positive bearing on the fundamentals of global economy.
Okay. Pramod, hi, morning. In fact, when we spoke with you last as well, you were telling us how you're circumspect on the markets, similar to what many other experts have pointed out, but this market has been slowly climbing the wall of worry. What would you do at this juncture? Would you stay away or, would you sort of sell into this market expecting this rally to fade? Absolutely.
I think being a fundamental focused house, we would look at what has changed on the ground, and in reality, absolutely nothing, be it in the commodities world or the nature of emerging economies. If at all, incremental data points have continued to remain negative. To that extent, we would go by fundamentals and sell into this rally because the amount of uncertainty and risk factors continue to remain, if at all, heightened. And this sort of what I would call as a liquidity-driven rally is always bound to have significant downsides when that liquidity goes away. It's hard to call when that goes away, but fundamentally speaking, I think this would be a rally to sell out.
Okay. Is there any chance of an Indian outperformance?
It is clearly we continue to stand out amongst most emerging market, Asia ex-Japan markets, where we often tend to be clubbed into. So to that extent, we might see some incremental flows. But like I've highlighted in the past, positioning by most institutional investors across emerging market funds or Asia ex-Japan funds, on an average, has already been quite positive towards India. I'm not sure if there is any further room towards weight India more than other markets. There might be a few exceptions here or there. But on an average, I think any incremental flows into these risk asset classes will get by and large proportionately allocated to India.
Okay, but just trying to play the devil's advocate here, Pramod, there are a lot of things that are working in favor of risky assets as well, right? I mean, for example, fund flows are back into emerging markets, as you mentioned. Globally, things are looking like a bit more stable than they were in the past couple of months. And technically, too, the setup is not as stormy as it was in the months of August and September. So don't you get a sense that perhaps just in the very near term till the end of the year, we could be looking at this risk-on extending itself?
Possible. Like I said, it's very difficult to call the timing when the risk-on ends or when the market will see through this further liquidity infusion and the fact that it actually hasn't made much of a difference to a fundamental economy. So to that extent, you're right, it might as well continue until Christmas, and we're all happy going into the new year. But I would rather not bet on a liquidity-driven rally. Stay focused on fundamentals, which don't look particularly good.
Okay, when you stay focused on fundamentals, what are the tea leaves telling you about Indian earnings? Is this the last bad quarter? Will Q3 at least inch up in terms of earnings growth?
I don't think we are close to the bottom yet. I mean, there might be pockets where we've seen enough, but by and large, we don't see any sort of indicator which suggests that things are picking up, if at all. From the economy standpoint, we continue to see the economy decelerating, and the effects of the new government in terms of cleaning up the system, be the attack on black money or the attack on the subsidy system, continues to have a bearing on the ground in terms of demand destruction. All this is good from a structural perspective, but I think the pain is here to stay for a bit more than just another quarter. It's hard to call whether it's Q3, Q4 is the bottom. We're pretty sure that we haven't seen the bottom yet.
What have you made of the earnings that have come in from the technology space this time, Pramod?
Yeah, that's been a surprise and a really hard one to call. We've been highlighting that the demand in the technology space has been shifting quite dramatically. The nature of technology disruption has meant that the way IT services is consumed by most of Fortune 500 companies is also changing quite rapidly. To that extent, it's very difficult to call whether in IT services in general and Indian IT in particular will be a beneficiary of this change or will suffer the might. And we maintain our view that this will be different. It's not going to be everybody winning at the same level. I think those who are able to adapt to these changes, who are able to foresee these changes, build capabilities accordingly, will benefit more than others. So you will have a few winners and you will have a few losers.
You will sell into this rally. What will you not sell in India?
I think we've maintained our strategy fairly simple. We focus on strong business models, cash flow generating business models backed by quality management teams who have a very high regard for capital allocation. I don't think there is any reason to look beyond these factors in terms of identifying companies. These could be across sectors, really. But if you're looking to get an answer on sectors, I still think something like a pharma, which has some visibility in terms of earnings growth, some private sector banks which have continued to maintain the momentum, perhaps could be the better of the lot. But like I said, good quality companies across sectors would still be the best place to stay.
As a trigger, do you think the Bihar elections, the outcome of the Bihar elections will move the needle of the market too much, whichever way the ball rolls?
Maybe in the short term, but I'm not sure how to read the outcome, really. I mean, even if it goes in the favor of the ruling government, it's not like it's going to make a big difference to their ability to push through reforms in the upper house of the parliament, nor does a result the other way question the ability of this government to do what they have begun to do. So I'm not sure if it makes much of a difference, but you're right, so maybe a short-term reaction could be warranted.
Okay. Pramod, what is the, the differentiation in these cash-rich and good promoter-based companies? Because many of them are selling at very, very tall valuations.
Yeah, I mean, look, that's the way Indian markets have behaved. Quality always comes at a premium. I think investors have pretty much made peace with the fact that if you want to buy quality in India, you have to pay through your nose. And I don't think that's changing. Looking at the way investors' portfolios have transpired in the last 12 months after the initial burst of rally after the elections, most of the money is shifted towards quality, and that's only made those stocks more and more expensive. But given the state of the economy and the markets and the headwinds that we're looking at, I think it does make sense to keep valuation aside for now and stay focused on quality.
Okay, stay focused on quality. What about, the mid-cap space, Pramod? Because we haven't seen too much of a run-up in the mid-cap space or too much of a sell-off. I mean, the expectation was that if there is a big sell-off that comes through, mid-caps will sort of crack and the bottom will, move out. But that hasn't happened. So from now, say for the next 6 to 12 months, where do you see more money to be made between large caps and mid-caps?
Like I said, I mean, as long as there's quality, it really doesn't matter which sector or market cap. But to the extent that in some ways you would want to be not exposed to too many illiquid names, that goes in favor of large caps. But to the extent you're happy with living with a 2 to 3 year horizon, the liquidity angle may not make much of a difference in terms of your choice. The mid-caps have been supported by some domestic flows which has remained robust, and hence perhaps not actually participated in the sell-off in August and September. And as a result, there wasn't much reason for the mid-caps to rally in the October rally either. So yeah, that explains the performance of mid-caps, I guess.
All right, Pramod, we'll leave it at that. Thanks for joining us and taking us through your views on the market. That's actually a cautious view coming in from Ambit. They say that they would use every opportunity to sell into the rally, and things have not improved on the ground. But let's talk about some earnings. In fact, things have not improved for some companies for sure.